Hi, I'm David Schenk. I'm an attorney and enrolled agent, enrolled to practice before the IRS, and I talk about tax issues, estate planning, and asset protection. Today, we're going to talk about the IRS Trust Fund Recovery Penalty, what it is, and why it's so painful. If you're an employer, or you work for an employer, and you have responsibility for financial decisions, especially the decision to pay or not to pay payroll taxes, you may be subject to the trust fund recovery penalty. Many small businesses, when they find themselves with cash flow problems, have to make some tough calls. If you don't pay the rent, then you don't have a place to work. And if you don't pay the workers, then you don't have staff. And if you don't pay the suppliers, you don't have anything to sell. But if you don't pay the payroll taxes, well, it doesn't seem like anything bad happens, at least not right away. However, many a small business owner or manager has learned just how wrong that idea can be. In the minds of the IRS, there's pretty much nothing worse than failing to pay the payroll taxes. These taxes are called trust fund taxes because they fund the Social Security and Medicare trust funds. But they might also be called trust fund taxes because employers withhold them in trust for their employees. And employers are obligated to pay them over to the IRS on behalf of those employees. In addition to Social Security and Medicare, the penalty is also going to cover withheld income taxes. In some ways, the IRS looks at failure to pay these taxes as a kind of theft, since the money isn't really the employer's to begin with. That way of looking at it may help explain why the IRS takes failure to pay these taxes so seriously. Generally, we think of corporations as having a separate legal identity from their owners and managers. If the company owes a debt, its creditors can't usually collect from the personal funds of the owners. Similarly, if a company owes income taxes, the IRS usually can't collect from the owners or the employees. But with trust fund taxes, they can. The IRS is going to look for owners, managers, accountants, bookkeepers, anyone who they think might have had some responsibility for the decision to not pay these taxes. And the IRS will hold all of them jointly and severally liable for the taxes, and for a penalty of 100% of the tax amount. That's right. You have to pay the tax and a penalty of 100% on top of the tax. This means the IRS can and will try to collect the full amount of the past due taxes, plus the penalty from any or all of the responsible parties. Being jointly and severally liable means any one individual can be held liable for the entirety of the debt. The IRS doesn't have to split it up amongst the responsible parties that they've identified. Additionally, trust fund taxes cannot be discharged in bankruptcy. Let's look at an example. Let's imagine that you're a small business owner with a single employee, and you pay that employee $1,000 for a week. And on the pay stub, you note that you withheld $100 for income taxes and $15.30 for Social Security and Medicare, for a total of $115.30. Now let's imagine that because of some bad luck, when the time came to pay these taxes to the government, you didn't have the money. So at first, nothing's going to happen. But then you're going to get a few letters from the IRS, and eventually more bad luck and the business closes. But someday the IRS is going to come looking for you, and they're going to want $115.30 in unpaid trust fund taxes, and an additional $115.30 in penalties. But now let's back up and imagine that you aren't the owner. You're just the bookkeeper, and you handle the payroll. And the owner tells you to skip paying the payroll taxes, and you do it. This time, when the government comes looking for their money, they're going to look to collect from both you and the owner. They can't collect twice. They can't get the full amount from both of you, but they can ask any one of you for the full amount. If the owner pays, you don't have to. And if you pay, the owner doesn't have to. Or they can collect part from both of you, but obviously it's easier for them to ask both of you for the full amount, and that's what they do. So while it may seem like the trust fund taxes can be skipped without too much pain, that's a very short-term view of what can become a very big problem. Disclaimer: this video and any accompanying text is for informational purposes only. The information provided does not and is not intended to constitute legal advice. No attorney-client or similar relationship is formed. If you require legal advice, please contact an attorney or other legal professional. This video covers a complex legal area in just a few minutes, and of necessity leaves out much of the detail. Don't make decisions based only on this video.